In March 2026, for the first time since the pandemic, Dubai property prices recorded a monthly decline. And I want to talk about it honestly because most brokers in this city are either pretending that it did not happen or they're using it to panic you into a bad decision. I'm going to do neither. What I want to do is I want to show you exactly which areas dropped, exactly why, and then tell you precisely where the smart money moved while everyone else was frozen. The Value Strat Price Index, which is the most credible independent tracker of Dubai residential values, it fell 5.9% in March 2026, and that is the first monthly decline since 2020. The drops were not evenly spread, and here is what the data actually showed. If we look at the villas, we have Arabian Ranches 2. This dropped 11.5% in one single month. Dubai Hills Estate dropped 10.8%. Palm Jumeirah, it dropped 8.4%. Among the apartments, if we look at Jumeirah Village Circle, JVC, that dropped 10.3%. We have the Burj Khalifa around that area dropped 10.2%, and Jumeirah Beach Residence, for short JBR, that dropped 9.9%. Town Square dropped around 9%. These are named communities. They are real numbers from Value Strat's own published report. Now here is the context that nobody is giving you. That 5.9 monthly drop only takes prices back to September 2025 levels. Year on year, prices are still 8.9% higher than if we look at March 2025. So this was not a crash. It was a 6 months of gains that has been given back in 1 month, triggered directly, obviously, by the geopolitical uncertainty in the region here, which started early March. By April, the market was already recovering. Property viewing activity was up 75% after the ceasefire, according to Allsop and Allsop. Off-plan transactions were running at over 80% of the total April deals. Institutional confidence had not moved. So what actually happened is this. The ready secondary market in high supply communities, they got hit hard and they got hit fast. Off-plan barely moved. The communities that dropped the hardest have something in common. They are older. They are established freehold communities with high investor ownership ratios. When the sentiment shifts, the investor-owned properties hit the market simultaneously. Supply spikes and prices fall. If we look at Arabian Ranches 2, Dubai Hills Estate, JVC, these are communities where a significant portion of owners are investors. They are not end users. Where confidence wobbled, motivated sellers, they appeared. But here is part of this story that does not go away when confidence returns. The supply pipeline in these areas has not changed. JVC alone has one of the highest new unit pipelines in the city. The underlying pressure that made those areas vulnerable in March is still here in June. While the secondary market in high supply areas was dropping, something else was happening simultaneously. Off-plan in scarcity-led communities barely registered the shock. Communities with fixed land supply, government-backed developers, and genuine lifestyle infrastructure, they held their value because the buyers in those projects are committed, the payment plans are contractual, and there is no motivated seller program. Dubai Q1 2026, total transactions hit 252 billion dirham, which is up 31% year on year. Recorded during the active conflict which is going on in the region right now. That number tells you something very important. The long-term buyers, they did not leave, they just adjusted their focus. The investors who understood the difference between a structurally sound off-plan project and a high supply secondary market community, they used March and April to move. They locked in launch pricing on projects in locations where the supply is permanently constrained. They are not competing with thousands of near identical units at handover. They own something with a fixed number of units a fixed amount of land, and a genuine demand driver that does not disappear when a global sentiment has a wobble. If you own a property in one of the communities that I have mentioned, do not panic. The market has recovered. Year on year, you are still up with your investment. But ask yourself honestly whether the structural supply picture in that area works for you over the next 3 to 5 years. If you are looking to buy right now, the question is not whether Dubai is a good market. Q1 2026 proves that it is. The question is, which part of the market are you buying into? Off-plan in a scarcity location gives you contractual pricing today, capital working during the construction period, and an asset at handover that is not competing with a wave of identical supply. That is fundamentally a different risk profile to buying a secondary market apartment in, let's say, JVC today. If you want to understand which projects I would look at right now, fill out the form in the description in the bio. I will come back to you personally with a breakdown of what makes sense for your budget and your timeline. The March 2026 dip was real. The recovery was real. The structural difference between the right off-plan project and the wrong project/community is real. Knowing the difference is the entire game. As I said, the form is in the description. Please do like and subscribe this video. It does help me keep making content like this. And as always, I will see you on the next one.